Welcome back to another episode of the Block Runner Podcast. I'm your host, William, always here with your co-host, Iman.
What's going on, dude?
And on the sticks, we got TJ.
Hello.
And joining us for the first time, we got Michael Lee Jr. from LienFi. Thank you for joining us, man.
Hey, thanks for having me. And as I mentioned, first time on the show, but long time listener.
Yeah, I really appreciate that. We've been doing this for quite some time now.
Pretty long time. Yeah, I wonder how long of a time of a listener you've been, but
Yeah.
We've
been through quite the journey.
Yeah, and I've noticed your online presence as well, especially around the BankerBot days. BankerBot's still a live and thriving ecosystem, but
yeah,
specifically around the debt relief bot days, I think. I remember when the base meta was really kicking off. You know, that was one of the more attractive little meme coin narratives that were happening at the time. Like, we made several videos around that, and you were, I think, like the loudest champion behind that. So that's kind of unrelated, or maybe it is more related to what it is you're kind of like emphasizing these days. But nonetheless, I think it is part of your origin story. So I think we should just start off there, because maybe your origins go even further back. I'm sure they do. So if you can, just introduce yourself and give us like a background of like how your crypto adventure has been so far.
Yeah, thanks. And around the time that after Grok created DRB on the X social feed, it was really kind of a crazy thing because of that wallet that was tied to it, and still is. But one of the crazy things was I was Googling or looking on YouTube one day, and I came across, you guys had a video that was already out there talking about DRB and the origin story and Grok creating it. And I had known your show from before then. And I always viewed you guys like Bitcoin guys that, anything that new that was happening around Bitcoin, I would end up catching a clip or tuning into the show. Like back in it's not too long ago, but like the Runes days and a number of other things. But yeah, I ended up coming across that episode. I was like, oh my gosh, I know these guys. I can't believe they did an episode on this.
Yeah.
But yeah, so that was cool. My origin story in crypto really starts around like 2016, 2017, when I bought crypto for the first time on Coinbase and thought that I knew everything about how crypto worked, because you logged into Coinbase at that time, there were three assets, Bitcoin, Litecoin, and ETH. I'm like, oh, Litecoin's the cheapest. That's got the most runway. Let me get that. So really didn't know what I was doing, but my journey really, I think, came out of curiosity. A guy named Mark Yusko was the CIO, Chief Investment Officer of a fund that I worked for out of college back in 2008, 2009. Graduated in 2008, but started in 2009. So I got to know Mark really well, and Mark was one of these early, at least early for me, institutional allocators that was willing to talk about Bitcoin and make the case for Bitcoin from an asset allocation perspective. And I kind of dismissed it when I first heard Mark talking about it, maybe 2013, and revisited Bitcoin later after like the 16, 17 timeframe, but still was, I'd say, very raw. I come from an institutional alternative investment background, both hedge funds and private equity. That's what I've done since I finished school in 2008. So we're getting up there in years, but that's been my whole career, from becoming a partner at a hedge fund and private equity firm to start over it for a decade, and then starting my own firm called Gondola Capital, going through an acquisition, Gondola Capital becoming Gondola Partners, which is where I operate my day-to-day right now. And one of the hedge funds that we operate is called the Tax Lien Fund, and that fund allocates to United States property tax liens. The investors are all institutions that allocate to tax liens and redeemable deeds to generate consistent, predictable income, but also act as a diversifier, because tax liens in general aren't correlated to traditional assets or even alternative assets. So that's kind of the path. And then that led to tax liens becoming tokenized on chain, which is what we're doing with LienFi. So that's 18 years packed into maybe like 90 seconds.
Yeah.
Yeah, it's always interesting when somebody asks us to kind of give our origin story. It's equally
as long.
Yeah, as long and, I don't know, just
bumpy.
Especially when you're talking about crypto, right? Because you're all over the place whenever it comes down to crypto. If you've been around as long as all of us have, we've seen a lot as far as like, new trends, new narratives, new, I don't know, killer applications / use cases for blockchain and crypto and such. And then those things tend to catch a lot of interest and, awareness. And then subsequently, liquidity follows into that, billions of dollars in some previous cases. So, that is kind of the premise and purpose of our channel. And is why we're talking to somebody like you, because you're obviously tapping into what seems to be the next wave on the horizon, right? Which is like RWAs, the tokenization of stuff that's not native to our ecosystem, right? Like we've run a lot of cycles where it's just like, how do we create value out of tokens?
Yeah.
And it seems like the future is going to be all about how do we port in the existing value like off chain to on chain and I guess do something with it, right? So if you can kind of give your take on like just the macro trend itself, like setting up what it is LienFi is built for, your interpretation and understanding of like, what this RWA sector, like what is the opportunity scope for it?
Yeah, I think blockchains in general are or users. Well, I even take that. I mean, users are looking for a lot of different things. I think folks want to make money in crypto, but the RWA kind of category, you nailed it. I mean, it's bringing. There are real productive assets that live in the real world that are off chain, whether it be U.S. Treasuries or private credit strategies. There are productive assets off chain that folks have looked to bring on chain, and I've heard a number of different ways. On chain yields tend to be reflexive yields and maybe not derived from like actual value that's being created. Um, the whole thesis around LienFi, first we saw stablecoins capture product market fit, and that took a while. I mean, stablecoins have been around for quite a bit, but it was really the last 18 months that we've seen a real uptick in the amount of dollars that are on chain. I think it's north of like 12 billion or 13 billion right now, and that number was just a couple billion a couple years ago. So we've seen that growth, and dollars naturally seek at minimum the risk-free rate. So if dollars arrive on chain and dollars capture product market fit, which we've now seen, those dollars naturally going to be seeking at minimum the risk-free rate, and that's why we saw treasuries kind of follow stablecoins, because treasuries offer kind of that risk-free rate, and that's what dollars seek. So the most logical thing, if dollars capture product market on chain, the next most logical thing is treasuries, and we saw that happen, and we're continuing to see that happen. After that, and kind of in conjunction, private credit, which is up the risk spectrum from treasuries and dollars, and private credit now well north of 10 billion on chain, and that trend I think is up and to the right also. And then further up the risk spectrum, you have U.S. equity, which now with Robinhood Chain and even prior to that, there like with Ondo, there's some options to capture equity exposure on chain. So we've seen this kind of movement from the dollars on the far left of the risk continuum all the way up to U.S. equity, and these are all RWA. These are all would be classified as real world assets. Somewhere along the way, so we run a hedge fund that has over 100 million in assets under management that focuses on tax liens for institutions. Like I mentioned, it's available at Schwab, Fidelity, Goldman Sachs, and Pershing. So it's all institutional allocators. But somewhere along the way, I'm watching this kind of product market fit be captured on chain with some of these real world assets, and up the risk spectrum, but somewhere tax liens kind of got left out of that. And I don't view tax liens as identical to treasuries, but I would put them, if we're talking that same risk continuum, I'd put them in between treasuries and private credit. And somehow along the way, that was kind of skipped over on chain. And the reason being is there just aren't a lot of tax lien kind of experts that that allocate to this asset class. It's a rather small asset class, but it's big enough where we could be meaningful to enough folks. There are about 8 billion in new tax liens that are issued every single year at auction across 3,000 plus different counties and municipalities. And at any given time, there are about 25 billion in tax liens that are outstanding, which we would classify as the secondary market. So it's a very meaningful TAM for us to be significant in. But for the really big players, it's just too small of a place or of a space to get them excited about it. So that's where kind of some of our edge came in, and then just the complexity around being able to navigate this asset class. These assets are sold individually across 3,000 different counties and municipalities at different times of the year. A lot of times these sales are only during one specific time of the year. Like you get Florida in May, New Jersey at the end of the year, Louisiana kind of through the summer. But it differs. So you have to have capital, you have to have the right systems and planning in place, and institutionalized systems that could be repeatable over and over again to be able to source, acquire, and allocate to this asset class. So a lot of the complexities we're dealing with local counties and municipalities. So the operational complexities are part of the moat as well. And it just became very clear that this is a great asset class to bring on chain. Tax liens also, they're not securities. These are claims on delinquent taxes. So there's another kind of unique aspect to tax liens and what we're building with LienFi, and the ability to offer them in a much different way than if these were security assets.
Yeah, I want to dig deeper onto the product here, but I want to understand a little bit about some of these, like the vocabulary here, like tax liens. So I don't deal with tax liens personally myself, just because that's not what we do really. But I kind of understand how this works. And correct me if I'm wrong, Michael. The way that I'm seeing this is that if you have a house, you need to pay property taxes, and let's say the property taxes are around $3,000. And if you don't pay the property taxes, then an investor can come in and pay those property taxes for you, and then the homeowner has to pay back the investor plus interest. Is that basically how this works?
Basically, and it's all run through the taxing authority. So just give an example, like we'll go off of your example, $3,000 delinquent tax in, say, Miami-Dade County. So Miami would run their auction, and but even taking a step back, so Miami-Dade County, their tax collector every single year identifies all of the parcels within their county and then levies a tax on those parcels. So we're not part of levying tax, or we're not part of the taxing authority. But what ends up happening is there's always a budget shortfall for these counties when taxes are delinquent. So let's just say if Miami-Dade County, in this hypothetical example, everyone else in the county paid their taxes, but this one parcel, and that was the $3,000 one that you mentioned. So right now, Miami-Dade County, their tax collector, they're looking at their budget, and they were expecting $3,000 more in tax revenue for their budget. And they realize we can't, that's whatever they use their tax revenue for, whether that's roads, schools, police, fire department. They've realized they have a budget shortfall now, and they're like, we need that $3,000 now so we could operate as if we didn't have a budget shortfall. So they will attract investors to come in and fill that hole. In essence, it ends up being like a loan to the delinquent taxpayer, and also affords that taxpayer a redemption period, which is usually depends on where, but like in Florida, this example it's 2 years. So we would go to this auction and we would say, okay, there's this $3,000 delinquency. The county is auctioning that off to an investor. We're interested in purchasing it. And the way it works in Florida is you bid on the interest rate. So the interest rates on tax liens are statutory, meaning they're set by law rather than market driven, like a Treasury. Okay. Price goes up, interest rate goes down. Inverse correlation between price and the rate. With tax liens, these are statutory rates set by law, but you don't always get the same rate. So there's a competitive dynamic to it. So we would go to this auction, we'd say, okay, we want to buy this $3,000 delinquency. We know that we're giving the county $3,000 that day because that's going to fill their budget, and that's what the tax lien is that's the face value. But our variable going into the auction is the interest rate, and the bidding starts at the statutory rate, which is set by law. In Florida, it's 18%, and you could bid down by a quarter of a basis point. So maybe I say 17 and a quarter, and someone else says 16.75, and someone's 13 and a half. And ultimately, the low bid would end up winning. And if the low bid got down to, let's say, I came in and said, okay, 9, that was the low bid. That day, I'm giving the county $3,000, and I start accruing 9% plus penalty. There's a fixed penalty as well, but you start accruing 9%. In Florida, interest accrues monthly. In New Jersey, it's daily, but you start accruing that up until redemption. We don't handle collections or anything like that. So the delinquent taxpayer 3 months later is like, okay, I was on vacation in Europe. I forgot to pay my taxes. Does happen all the time. They go to the county portal. They pay their delinquency plus the accrued interest to that date. And then the county receives a check. And then the county goes and say, okay, we just got this check for these delinquent taxes. Let's see who's on the lien. Oh, tax lien, Michael Lee. There you go.
Yeah.
And we need to send that money to that person. So the county would then take the proceeds, send it to the name on record on the lien, and then that lien would be cleared. It would no longer exist, and we'd be clear of our position. We made our return. Hopefully the homeowner's happy. They weren't foreclosed on. Their house wasn't taken. That's generally how it works, with slight nuance across the country depending on state and jurisdiction.
Okay. So I totally understand. And before we get to the tokenization part, I have one additional question. So this is an example where someone was on vacation, comes back, pays the penalties and the interest. What's the lead time before someone gets foreclosed on a house, and is it different per state?
So if there weren't tax liens, if there wasn't an investor coming in to clear those delinquent taxes, like most of the world outside of the United States, they don't have an established auction system like we have here.
Oh, I see. Okay.
What ends up happening is, say, okay, you owe $3,000, you didn't pay, a year is up, and we're going to, now the local municipality will sell their house for $100,000, and they'll take $97,000, give it to the homeowner and say, here's your 97, we're good on our tax now, good luck finding a new house. In the United States, it doesn't work like that. They have this system where they allow investors to come in essence, like bail out the delinquent taxpayer for a period of time. In Florida, it's a 2-year redemption period. New Jersey's 2 years. Some places it's 3 years. Some places it's a little more aggressive, like Texas could be up to could be a year. So there's this that's called the redemption period.
Okay.
So like in Florida, it's okay. We bought the tax lien on June 1st of 2026. The redemption period ends on June 1st of 2028. If it's not redeemed or cleared by that 2-year redemption period, you could then move forward with foreclosure proceeds, sheriff sales, et cetera, depending on the jurisdiction that you're in. I will say that greater than 99% of all tax liens redeem, meaning that they got cleared with interest and penalty rather than getting the property. If you ever meet someone that's involved in tax liens and they say, tax liens are a great way to acquire property for cheap, it's not true. Like you don't typically, like that doesn't typically happen at all. It's less than 1% of the time that happens. If anything, the greater than 99% of the time, you're capturing interest and penalty on the position and you're not getting property. That's just how it works. But there are folks out there that market tax liens like this is a great way to get property for cheap. And I can assure you, after our fund buys tens of thousands of tax liens, hundreds of millions of dollars worth of tax liens, if you're not buying at scale like that, if you're buying 100 tax liens a year or 500 tax liens a year, you're just getting interest and penalty. You're not getting property. That's really how the system is designed. But the one caveat to that is these small little positions do sit senior to the property. So if they aren't redeemed, the position sits senior to the property, so you can move forward with disposition. When that happens, the less than 1% of the time within 3 years or in that 3-year time frame, when that happens, these are not typically houses that, this is not the Palm Beach waterfront property. Like, this is a property that's been severely neglected.
Mm.
It's a distressed property at that point. Typically, it's abandoned. These aren't properties that, like, people are like, wow, I'm so glad that I got this.
Mm-hmm.
But they're the communities that, the community in the situations that end up like that, communities do benefit because before you had a house that was abandoned, run down, nothing going on, tax liens on it. And then eventually, if someone can take that property, apply some capital to it, fix it up, it does benefit the communities and turns these properties that have struggled from a community standpoint back into a productive asset. And we see that happening through our efforts all throughout the country.
Yeah, it's really interesting how all this works, because this is not like, I don't know, this is not a common thing that like regular people discuss, but it is a big market, like you're saying, and it's now being tokenized. So now let's talk about how you're tokenizing these assets so that anyone can participate, like anyone can purchase these tokenized debt liens where I would pay the $3,000 and then earn that, potential 9-10% interest.
That's right. Yeah, there's some limitations as well, obviously, like sanctioned areas and things like that. And we've got updated like docs coming out on all of that. But yeah, generally yes, with some very minor exceptions. And again, like these are not securities; they're
Mm-hmm.
simple claims. And the way that we've structured this is really has the ability to open up this market in a more global and permissionless way than we've ever seen before to date. So the tokenization aspect of it right now is everything on the marketplace is secondary. So there's no issuance going on from Miami-Dade County. Miami-Dade County isn't coming to LienFi and saying, okay, we're going to handle our issuance on chain. Uh, but buyers of tax liens that already utilize the secondary market, like the tax lien fund, is very active and has been for years on the secondary market with other institutional players. Being able to bring a lot of that order flow on chain is something that we're very keen on due to the fact that it's faster, better, cheaper, more transparent, and really opens up this very bifurcated data industry. If we execute, it could really add a lot of advantages. And some of the trading partners that we already trade with institutionally off chain, we're bringing on chain with us. And that first partner, over the next week or two, we should be ready to roll that out. But so this is not just we're putting a product on chain and hoping the existing dollars on chain are attracted by
Mm-hmm.
what we're building.
Right.
We realize some of the efficiencies that on chain can bring to already what we do off chain with other institutional partners. So we feel really good about what we're doing in that regard because we're really educating an entire class or industry of folks who, prior to us working on this, had no idea about this space, and they're going to become on-chain users that bring TVL on-chain, and it's pretty cool to see.
So I'm curious, what is the risk for an investor if you buy one of these assets and this is enforceable by law? I would assume that there's almost very little risk. Would that be correct?
Yeah, I mean the risks are, I'm trying to balance my comments. If I was talking to one of our fund limited partners, and also, that is a regulated securities business, whereas LienFi is just individual tax liens right now on chain. But let's just talk about tax liens in general. So the risk of investing in tax liens in general. So if you buy a tax lien, there are really three possible outcomes. One is it gets redeemed with interest and penalty, meaning the delinquent taxpayer came in, cleared it, or there was a mortgage on the property and the lender decided that they needed to foreclose And if they want to foreclose, they need to pay the tax lien. But that's still a redemption. The buyer of the tax lien received back their principal plus interest and penalty. Far and away, that is the highest probability outcome of any in tax lien investing. The next outcome is it's not redeemed, and you don't get back your principal, your interest and penalty, and the redemption period ends, and there was no mortgage on the property, so the lender isn't, there's no lender to clear this. Property's abandoned. You need to move forward with disposition of the property. And at that point, depending on the state that you live in, you can force a sheriff sale, or in places like Texas, you can basically, at the end of that time period, you own the property and you can go and sell the actual property. So you could recover that way. The third outcome is that the lien never redeems and you decide not to go forward with enforcement, and you don't go through with the operational steps there, and then you lose your money. In anyone operating an institutional fund, if they end up with positions that are outside of the redemption period, they're going to go through with property disposition. So your real risk is, did you buy? The real risk in terms of if that lien wasn't redeemed is, let's say that $3,000 you spent on the lien in Miami-Dade County, that the actual house, the actual property, there's not enough equity cushion to be able to sell it and make your money back. So in the case of being $3,000 in, the real example would be that in year two, it was the taxes were delinquent again, and you decided to pay the subsequent taxes. So if you're the primary lien holder, if the second year's taxes are delinquent, you could come in and pay them as well. So then in year two, you pay another $3,000. So let's say you're $6,000 in, and now you're into that. After the second year, you may even pay a third year. So you may be like somewhere around $9,000 in. But if that's not cleared, and you have to take the property, and that property is only worth $8,000, now you're in trouble. You've got a loss. If you have enough equity cushion above what you paid on the tax liens over multiple years, then your risk is, can you sell the house? Can you sell the property? Is the property marketable? So you look at some of the sales in Arizona, and there's these tax lien sales on vacant land with no road access, no plumbing, in the middle of nowhere. You could be sitting, like, if that's not redeemed, you could be sitting on that asset for a very long time and not being able to sell it because it's not really a marketable piece of land or property. So that's some of the risk. And then, but the big things we look at on the fund side are like, it's not losing. I mean, it's tough to lose money. We're trying to optimize to a return target. So there's certain things that need to happen operationally to be able to get there each year. And then Ron DeSantis down in Florida, over the last 8 to 10 months or so has been discussing eliminating property taxes in Florida. So those are politician talking points. It's very unlikely that happens. These governments have to charge us taxes, whether we like it or not. I don't really like it, but that's just how it works. So if Florida were to eliminate property taxes, or if property taxes were eliminated wholesale, like, our existing business would be fine, but we would have no capacity for future business.
Okay, so I'm curious on you were talking about the secondary sales, and before we get there, I'm assuming these transactions that you guys make are in the orders of millions of dollars, right? Not the $3,000 purchase of a lien. So when these assets are tokenized, I'm assuming a lot of people would come in and actually do the purchases for the $3,000. So I'm curious, what does the individual have to do to follow up on, like, recovering the investment?
Nothing. So you buy the tax lien, and your folks, the county or municipality starts sending them notices in the mail, like, you need to pay your taxes by X, and let's say it goes after the first year, then the delinquent taxpayer starts getting more notices. Your property's redemption period's ending. If you don't pay your taxes by X date, you could be forced into a sheriff's sale, et cetera, et cetera. And then the taxes get paid. So we don't do outreach to, we buy thousands of liens, tens of thousands of liens a year, hundreds of millions of dollars. We go to auctions, we buy these assets. The complexity around tax liens becomes a little bit more advanced when you start to get out past the redemption period, or even in like out past the first year. Now you have the option to pay subsequent taxes, which are like the next year's delinquent taxes, and that's a choice that you can make. If you don't, they go to auction as well. To your point on, are we buying, like, so run a fund that's north of 100 million. We are buying liens that are $3,000, but we're also buying liens that are $5 million and $160,000. So it really runs the gamut. I'll give an example. In Florida, we screened $1.2 billion of face value in 2026 this year for the May auctions. Out of that 1.2 billion, we screened that down to about 80 million that we'd be willing to bid on. But out of the full 1.2 billion, the average lien was about $4,500. But there were some that were multiple millions, or some that were 160,000, and then there's some that are $180. We're typically not bidding like those very low liens, but we will bulk buy at an auction 100 liens that are $2,000 or $3,000, and so that's something that we definitely do. We're kind of agnostic on size above a certain threshold, and we're more focused on like redemption probability, which is you could be like the worst tax lien investor in the world, and your redemption rate is going to be hot in the 90s. Like the liens get redeemed. It's really how you build moats around this industry, your operations, your institutionalized process. And that's like a number of things that we've built in over the years.
Do you have a question?
Yeah. I'm just kind of trying to wrap my head around all this. Just because I don't have like a full scope of understanding of even the traditional world even works, to be honest. Like,
he's digitally native.
Yeah, very hardcore. Most of my existence lies there, and but what I'm kind of interpreting in my head, this feels like it feels like we're going to at some point, contingent on your success and other people building, platforms and protocols, that are adjacent to what it is you're working on. It's kind of like whenever we were first introduced to or discovered collector crypto, right? Totally separate markets, but we were trying to understand. It's like, how is it there's an on-chain RWA business that's generating billions in revenue, and like nobody on chain really had any like privy to like what is happening there. I think it's because they figured out like an on-chain business model that improved the efficiency to an already existing market demographic that was outside of our scope of, on-chain users.
Yeah.
And then by surprise, like we just found out about it later, right? Because they already had people, which sounds like what you're saying. This is obviously a very active market. Mm-hmm. This is institutional grade type of, financial activity. This isn't like crypto trenching, right?
Yeah.
But nonetheless, you've discovered like efficiency rails for this existing market. So most likely at some point, if you're right, we're going to see probably billions of dollars in, flows happening through protocols like this. And then again, like another discovery point, like on-chain natives, like how the fuck?
Yeah.
How are you making billions of revenue? But I'm wondering, like in the same sense with the collector crypt, it's like, okay, they figured out a killer on-chain use case and a business model, and they have a token, but it's not like necessarily understood like what that token has to do with that like very successful business. So you're kind of like on the way potentially to like a very successful on-chain business model, and you also have a token now, right? So if you can kind of like explain that dynamic, and if just start off with that.
Yeah, I think tokens are great. I love tokens for a lot of different reasons. You guys know I love meme coins like DRB, like that Grok, was involved in creating. I find that stuff just like very fascinating, and then how value accrues to like a Grok wallet. So something like LienFi, the native network token for the LienFi platform, there are a lot of current users and market participants that are curious around the exact model around LienFi and how that's going to work. And we'll be publishing some information on that very soon, as we've made some I guess, business decisions and changes to how we're building out this entire platform. But one of the things is we have, and we've already stated this, LienFi will be used absolutely for incentives on the platform. So ecosystem incentives, that we have some really, I think, unique ways to bring that to bear. But everyone knows that ecosystem incentives in and of themselves are typically like sell pressure. So if you're giving out the token for participation, rewards, and that in that regard, most people sell their rewards. Like, it's just how it works. So being able to counteract that in other ways that aren't perhaps sell pressure is something that we've really spent a lot of time on. One of the models that I'll just, I guess, briefly touch on, and it's a bit premature, and I said on a couple other podcasts, like when we publish the docs, I'll be happy to come on and explain all of the mechanics. But one of the interesting things about this space, there are a lot. So we have our fund. There are other institutions that do something similar to us. But then within the tax lien space, there are also a number of, I guess, smaller players that provide education on tax liens, and they have their own clientele, they have their own supply that they source at auctions, and then they have their own buyers. And we've had a number of them reach out to us with significant interest in being able to white label, or basically utilize the infrastructure that we've built with LienFi as an interface to be able to interact with their audiences. So we brought on Jack Dishman, who is, and Jack's not working for us. I mean, Jack is equal partner to all of us, and executive level on this team, and will transition as well to the full platform that we run here as we work towards this consolidation towards year end. But if you look back to what Jack was able to do with Clanker early on, it was utilizing other groups as an interface for Clanker. One of the biggest successes that came of that was BankerBot, was one of the interfaces that utilized what Clanker built, and that also led to, ironically enough, the Grok coin and a number of other really interesting things, and really changed, I think, the growth trajectory of BankerBot just by being able to utilize this infrastructure and market it appropriately. We're working on a very similar setup, which allows a lot of these historically off-chain groups to utilize our infrastructure, and also, as part of that, without going into too much detail, bring in a token component to, and token meaning LienFi, to how these third-party interfaces are interacting with us. Many of them will be listing certain assets at a premium on the secondary market, which creates a nice spread. Some will be listing at a discount as well. But we think that we've got some pretty powerful and maybe not before seen feedback loops that will align the LienFi platform with the LienFi token and the ecosystem in general, that I'm really excited about. And the other thing that I've learned is these things take longer than I would ever expect in many cases. I think, like right now, now that Jack is kind of ripping on the CTO and the technical side, some of the bottlenecks, I'm like, I wish we could have had a lot of this stuff out like 2 weeks ago, a month ago. But some of the design aspects and the way that we're setting it up is taking a little bit of time. So I guess to sum up, like LienFi, what I'm able to share now is ecosystem incentives that will be, I think, well taken by the folks that are utilizing the platform and have interest in the platform. And then some feedback loops on the other side as we're introducing some of these third-party interfaces, and also just the platform in general. The same model can work across both, but that's some of the things we're working on, and we'll be able to share more on it soon.
Okay, so so take me through the sort of product experience. What is the inventory that people would be purchasing? Is it the actual tokenized liens like on the platform people can buy?
That's right.
Okay,
Yeah. So LienFi has a custody arm called LienFi Custody Services LLC. That's the custody arm that, let's just say, a hedge fund that buys tax liens, or the retired guy in New Jersey who bought 10 million in tax liens after selling his business for 50 million. Real story. Decides, hey, some of these liens I'm willing to take some liquidity on, or they haven't redeemed yet, and I want to sell these. They'll be able to utilize our infrastructure. And the way that it works is, if you want to sell a lien on LienFi, you need to pass over custody to LienFi Custody Services LLC. The reason being is, if that lien gets redeemed, we need the check to go to LienFi Custody Services LLC, not third-party guy that we don't know or may know, but we don't need to be chasing down, because after that redemption, the redemption needs to flow directly through to the on-chain holder. So we custody everything. So basically, if an institution that holds liens wants to utilize our marketplace as a secondary marketplace, they would basically give custody to LienFi Custody Services LLC, and then those assets can be listed from there. And then the sale proceeds would go to whoever decided that they want to list those assets. And if they get redeemed, then the redeemed assets go to the custody sleeve, and the custody sleeve turns that into the on-chain proceeds. So
Okay.
that's how that works right now. Ultimately, we are very big believers that every stock, bond, currency, commodity is going on chain, and not just some of them, all of them. So right now, we're seeing equity. We think every single equity will live on a blockchain, whether you're buying that from Schwab, Fidelity, or Ondo in your decentralized wallet or your crypto wallet. So if that is the case, and we're right about that, then that would mean that eventually issuance of tax liens will go on chain, and Miami-Dade County, rather than selling through a database that lives on a server, would be able to issue these assets on chain. And if all counties were able to do that, and all municipalities were able to do that, the transparency and a lot of the problems that we face as institutional allocators in the asset class will be innovated away. And based on our standing on the institutional side with our fund, we are, in some of these counties and municipalities, the largest holder in those counties. So you get to build relationships with these folks. And I wouldn't think, one of my goals would be eventually to be able to pilot a program where you're actually issuing these assets on chain, rather than LienFi just being purely secondary marketplace infrastructure, but actually having the infrastructure built to handle issuance. And this first round, this earliest stage that we're in, kind of proves a lot of things that we're able to do. We've already been able to tokenize almost $500,000 worth of Florida tax liens and run the actual redemption process on redeemed liens from off-chain to on-chain. So while in earliest days, this process does work, and yeah, we're going to keep going on it.
Yeah, so that means that in your platform, your marketplace, your suppliers essentially are people who are already holding these liens, these assets, and they're saying, I have about $1 million in liens that if I wait long enough, it will convert to maybe 1.1 million, right? So give or take. But I don't have that time horizon because I need to buy a boat, right? So he could take those assets, put them all on chain on your platform, and then the I guess your buyers would come in and see which one they like, and hopefully it recovers roughly 1.1 million for this guy, or
Well, you know the redemption value. So, uh, well, it depends on when it's redeemed, but so let's just say if the guy had a basket of liens that was current redemptive value today was $1 million.
okay,
If these are New Jersey assets, tomorrow they're going to be worth more than a million, and Thursday they're going to be worth more than the day prior, and Friday they'll be worth more than the day prior because they accrue and they increase in value every single day. So this particular seller with $1 million redemptive value today, may decide how much does he want that boat. Like he may decide, okay, I know that this is going to be worth, roughly 1.2 million if these liens are held for 3 more months. But I'm willing to sell it for 900 today because I bought it for 850, and I'll take a very small profit because I need cash.
sure,
Or he may say, look, these are great assets. It's early in the redemption period. There's a lot of accrual left. Yes, it's worth $1 million if every single lien was redeemed today. But I think, based on my calculation, that this portfolio is going to end up like at 1.3 million or 1.4. I'm going to sell it for 1.1
sure,
and sell it at a premium to what it's worth today. And then the buyer would have to go in and underwrite that and understand, is this accurate to buy at a premium? So sellers on the platform could list at three different values. They could either list at redemptive value, and that would mean that the listing price changes every single day to match with the current redemptive. So you're basically buying it at today's value, and then it'll get more valuable as time goes on. Or they could list it at a fixed discount to redemptive value or a premium. So you may want to sell at a 5% premium to redemptive value, and every single day your listing price would go up to match that 5% premium.
yeah,
Or if you said I want to sell at a 5% discount to redemptive value, every single day your listing price would reflect that change based on what the redemptive value is, or you could just sell at a fixed price as well. Right now in the early kind of testing out the beta, everything is listed at redemptive value. We don't really have any third parties except our affiliated entity that's on the platform right now. That's changing in the next week to 2 weeks, and then these folks will have the freedom to list their assets at a value that makes sense to them, and then we'll see if it makes sense to the market.
So before everything went on chain, what did this $1 million lien holder had to do in order to liquefy those assets sooner rather than later?
Well, they would call up another hedge fund like ours or someone else and say, hey, I've got this opportunity to go buy, $1 million worth of Texas redeemable deeds at 13%. I've got this $1 million portfolio right now that's at 9. I need $1 million cash because I want to go and get the 13.
Yeah.
And I'm okay with these assets. I'm good with these, and I've got a better opportunity somewhere else. So they call us and say, okay, we've got $1 million. It's at 9. They want to do something else with capital. They found an opportunity that they think is more interesting. And then we would look at it and say, okay, $1 million at 9. We would underwrite that portfolio, analyze it, and say, okay, that looks good. Here's $1 million. They give us those assets, and now we add them to our fund. They've got $1 million cash. They go buy what they wanted to buy. That's somewhere else getting 12 because an opportunity they found, and now we just inherited $1 million book at 9%. That $1 million next month becomes worth more than $1 million, and next month becomes more than that because it's accruing from. That's if we bought it at the redemptive value.
Yeah.
If we bought it at a discount, then immediately we'd be, if
In
every lien, let's just say this $1 million redemptive value book was sold to us for $800,000. If the next day every single lien was redeemed in there, we'd get $1 million, and we would have made $200,000. But that's these liens, they redeem like all over the place. So
yeah. So okay. So that makes sense. So that sets the stage for like everything being off chain. So how does that translate to an on chain experience for this individual, $1 million lien holder? Is all the liens that he has become like individual assets that can be purchased?
Well, they are. Yeah. So off chain, that's how they are. The only reason that they become like, let's look at the tax lien fund. We buy individual tax liens and then we put them into a limited partnership hedge fund structure, 3C5 fund. And so then when an investor invests in our fund, they have exposure to the full pool of assets.
Okay.
The private beta that we're running right now on LienFi is all individual one-to-one assets. So there's not a pool, it's not pooled. Pooling assets in tax liens is really like the easiest way to do it because they are a lot of smaller pieces. You can make a single investment, get exposure to a diversified basket of liens.
Mm-hmm.
That's how the fund is set up. But on chain, in the earliest days of us launching in private beta, we needed to match these assets one-to-one off chain to keep the regulatory kind of framework around these assets intact. These aren't securities. If we went on chain and we said, okay, we're going to pool a bunch of these assets together here out of our US based entity in Delaware, we're going to sell that to investors on chain and they can make a $10 investment and get access to this $1 million pool of tax liens.
Sure.
Our favorite three-letter agency would call us up and say, hey, what are you guys up to? You guys are pooling assets on chain. You guys are creating a security. So now with that said, private beta is how we have LienFi set up right now, is proving that this structure works, proving that the off-chain to on-chain rails are working. But having curated vaults around these assets, having perhaps pooled assets with a different regulatory setup, and building custom portfolios that generate specific kind of yield targets, we have the ability to do all of that, and but that's a little bit, I think, premature for where we are with LienFi right now. But that is something we're talking with all of the major kind of vault curators and folks that are generating yield in some shape or form on chain around how these assets can perhaps be a part of a much broader on-chain economy, including lending, because and if you're involved in lending, you would be more than happy to lend against tax liens. I mean, these assets, when you think about loans that get serviced, meaning they get paid back, it's greater that like in some cases it'll take a little more time, but you get your capital back or you sit senior to the house. So lending against these assets as collateral, if you could take a bit of illiquidity, it's a beautiful asset class to lend against. And we've talked to so like Bank of America off chain, they don't want to lend against a tax lien book. Pristine collateral is collateral that's considered daily liquid at any given time. Like that is not tax liens, but pristine collateral, if your time horizon is slightly not needing it a daily, be the likelihood of getting your money back plus interest and penalty. And with tax liens, it's extremely high. So we could stomach illiquidity. We'd be happy to lend against these assets. And we've talked with a number of the off-chain lenders that already lend against tax liens off-chain, and showing them how easy it is to lend on-chain, to understand exposures on-chain. So we plan to bring in off-chain lenders to the on-chain world, as we kind of develop this platform. Because if we had 100 million in liens right now held on the platform, there are a lot of people that would be more than willing to lend 70% LTV, $70 million against that 100 million in assets. And that's another piece that like bringing these assets on chain will open us up for.
Mm-hmm. So I'm trying to understand the scope of this in terms of capital. Is it similar to when companies go public, when they IPO, they're accessing public capital, and that tends to be much larger than like an investor pool, where when you're putting these liens on chain, you're essentially accessing public capital? Is that sort of like a good way to look at it?
Well, when you have an IPO, you're selling shares to the public for one time, and then those proceeds come to you. That you're raising money, as a company through a public offering.
Right.
So when liens are listed on our platform, there's no, um, like you're selling an asset, you're selling a claim on delinquent taxes, and you're getting money for that. You're also, you're getting rid of the asset per se because you're giving custody to someone else, and if it redeems, you don't get that money anymore.
Yep.
The on-chain holder gets the capital, but each one of these individual liens is non-fungible. Like they're all specific to a specific property or parcel. So if there's 1,000 instruments or assets listed on LienFi, that's 1,000 non-fungible instruments that all have their own unique characteristics. Whereas in the IPO, you're selling shares that are all the same, unless you have different share classes depending. But whatever goes to the public market is
Sure.
everyone's buying the same issuance. So um, maybe some similarities, but I'd say it's more closely aligned with private equity and selling of secondary interests. So you own Anthropic shares in the private market, and you want to sell those Anthropic shares because you need liquidity, or your SBF in
Yeah.
if someone comes in to execute your estate. Um, that would be more akin to like a private equity secondary sale of an asset than like an IPO. But I guess the private equity secondary sales could be considered almost like um, they all have somewhat. I guess they're similar. I'm talking myself out of it.
Well, there. Yeah. So what I meant is not like the structure of each transaction. It's more about the access of capital. So the point of going to an IPO is like, for example, SpaceX, they raised like 70 billion. To do that in the private equity, that's like very hard to do. But publicly, right, he did it, right? He achieved it. So bringing these liens on chain is that's the motivation, is that you're accessing more capital, therefore making these assets more liquid in kind of real time.
Well, for secondary traders, like if you're trading secondary anything, you want liquidity. So right now we trade secondary off chain, uh, and we will continue to as this kind of evolves. We perhaps everything comes on chain, but transacting in the secondary market. I'd say the bigger thing is this asset class is very, very difficult for lack of a better term, for retail to access at scale.
I see.
uh,
Okay.
like a institution like ours that we operate in this space at scale. So it becomes, I think, for the on-chain participant, it's definitely like it opens up a new market that would be much more difficult to participate in if it weren't for like the innovation that we're bringing to the table.
I
But
see.
anyone could go to Miami-Dade County and buy a tax lien. Like you don't need to go to LienFi on chain, but you need to go to the county, you need to register, you need to make a deposit before the auction, you need to source, there are a number of things that kind of that create complexities around doing that.
Yeah.
Whereas our idea with LienFi is you can go to the platform, deposit with Apple Pay and Apple Pay, and with a couple clicks, you can gain exposure. And we want to bring that across the entire country, not just Florida, which is what we started with. Um, so that's
Okay.
it's really offering, I think, access, and then also, obviously, like what's in it for me if you're an institutional fund, it's opening up the market to a much wider audience, and rather than just being able to trade secondary market with X, Y, and Z off chain, or the fund in Philadelphia. Perhaps there are on-chain vault curators or on-chain stablecoin holders that feel that the yield that's associated with tax liens makes sense for their portfolio, and decide to participate.
So I guess my last question, and we got a few more minutes, and then I'll leave you to kind of like talk about how people can access you and start engaging with the platform. So the investor that you are trying to attract is like a specific class of, like, let's say retail, where some retail investors are looking for dividends, right? They look to like dividend stocks, and Is this like a specific type of retail investor that you're looking for to access the platform, or is it more like institutional level?
Yeah, so I'd say it's both. For anyone that's looking to generate yield on stablecoins, so there's north of 10 billion in stablecoins right now on chain. Uh, there are, believe it or not, there are retail allocators that are that like generating yield on their dollars and not just speculating on the next 5x or 10x.
Yeah. Yeah.
And I'm saying I like doing both of those things. Don't get me wrong, but there is a portion of capital that I feel very strongly in from my personal finance structure that I want to generate yield on in a fairly consistent way without taking significant risk uh, or risking permanent loss of capital. So I think right now there's definitely like the volumes on chain are dominated by speculative trading, and a lot of that is meme coin driven. And again, not knocking that space. I participated in it. I participated in it myself. But as these markets mature, I do think that there'll be even more retail folks that are interested in building portfolios where you have a risk portfolio that perhaps you're taking risk with X%, but 10% of that you're comfortable getting a very consistent, predictable yield that's not correlated to the rest of the portfolio.
Mm-hmm.
That may not be the exact kind of nature right now of the on-chain trader, but there are definitely folks out there that are doing things similar. We see it with X money, folks being willing to deposit capital into X money to get a higher yield on their dollars. And I think we'll continue to kind of see that trend. But yeah, right now, LienFi doesn't have this like deep degen, or I don't know, deep, doesn't have this like degen trading nature to it. There are some ways that we might be able to make tax liens fun. And I was mentioning this to Danny from Banker. They're like, no, just keep it boring. Like, just keep it boring. But we're trying to experiment with like different ways to perhaps make this more attractive to that kind of market. But at the same time, we're going to keep the kind of nature of the asset class intact for folks that want to generate real and consistent, predictable yields off of these assets. And then hopefully when we bring lending to the table, folks that are interested in that category would be able to participate as well.
Yeah, I think naturally it'll probably evolve into that direction. Like instead of like trying to force it too early, in a sense, like if you execute on basically your vision here, I mean, because you're right, this is bringing in I think a pretty
important primitive.
Yeah, to the sector of DeFi, right? And like it needs something that's more reputable, something that's more institutional grade, instead of like pure speculation, like a lot of like smart contract risk dependencies and all this stuff, right? So it's like a different palette, if you will, of like you're saying, stable coin holders who wants yield products, but might not necessarily want the existing infrastructure to be the providers of that. So it's like,
but I think we're going to be able to bring yields to DeFi that have never before been seen in DeFi, and they're real, and we've executed on it, and with a 5+ year track record from an institutional standpoint. So that to me that's exciting, and we'll see what kind of uptick we get off of it. But I'm excited about like bringing some of the highest yielding assets to DeFi.
Yeah, but you're also right in the sense that for it to become like attractive, and therefore, because everything we've just discussed in the last hour, it's like a huge, I mean, we talk about the pendulum all the time. Like, the last cycle we experienced the pendulum in the full like degeneracy, lowest degree of fundamental requirements, like understanding the fundamentals of anything, right? The dogma of the last cycle was like, keep fundamentals away from crypto, and that's how we're all going to win, right? Because the previous cycle burnt us with that kind of stuff, right? Yeah. So it feels like the pendulum is on its way into the full swing in the other direction, where it's like you've got to bring fundamentals to the playground now.
Yeah.
And that's exactly what this is. So you as a degen trader, speculator, whatever, participant in the crypto market side of things, you got to level up.
Yeah.
You're going to have to understand all this technical financial jargon.
Yeah.
in order to make the right plays, right? But nonetheless, and in order for them to kind of like be driven to take that mental leap, it will probably require things like, who can create like the stockbroker version of this, right? And within like this asset class, because it's like,
Well, I mean, I had a guy, I had someone DM me with this wild idea around LienFi that like they don't need me for, but they could go and build based on like the Lego blocks that we put in place. And I was reading, I was
yeah,
like, holy cow, this is nuts. Like, we'll see if they do it, but like turning this asset class into like,
mm,
or even what we've built into with LienFi, like into somewhat like degen fun,
yep,
very, yeah, things
yep,
that I wouldn't even ever think about. So,
yep.
we'll see like how this evolves, but there's been a couple of them that I thought were really interesting. Um, we'll see how it goes.
How can we keep tabs on that?
Yeah.
Like on the evolution of this experimentation, because our audience, that's right up our alley, right?
Yeah. So, everything I post public, it's at Emily Jr. on X,
Mhm.
and then LienFi at LienFi app on X, and then the other folks that are looking to build all these that are contemplating building some of these like other unique things in the category. You know, I yeah, I get a DM and I'm like, hey, this is really cool. This is really interesting. And then who knows? It could be launched in like who knows? And maybe they don't do it, but
Mhm.
um, yeah. So, but if you're following me, like Emily Jr., you guys know that like I like to bull post. So if there are exciting things going on, I'm gonna post about it.
Great.
Hell yeah.
Yeah, I'm looking forward to that, because yeah, it's interesting how like stock tokens have been around, I guess, for a while now. Like, in most of crypto wasn't really aware of that
Yeah.
until suddenly Robinhood entered the space. And then you look at the comparisons, like Solana has like 20 times more like, equity value on chain than Robinhood does. But there's like,
Yeah, I mean, Ondo's been
yeah,
crushing it in that category for a long time. Like, it's
yeah.
not new.
Yeah, but it's like to the degen, right? It's like it feels new even though it's been around, right?
Yeah.
So
Yes,
yeah,
yes,
so it takes some sort of like catalyst of awareness, and like, again, a certain cook that's palatable to the degen for them to understand the opportunity, right? And so
yeah,
yeah, for all that's going to go across the board, right? Whether it's tokenized real estate, tokenized debt liens, whatever, right? So, but they'll figure it out. That's what
Yeah.
crypto degens are great at, is figuring out the right cooks, right? So as long as you put out the primitives and the tools and the infrastructure, that's the stage that follows. But like you said, you're not really depending or relying on that, right?
Yeah.
Because you have an existing like
Real business.
a real a real base of users who don't need to go through the mental loops to understand what's happening here, right?
Yeah.
But I think a combination of the two is important, just for like
It's like marketing.
yeah, I was gonna say exposure's sake, and then also maybe like the last thing we should maybe touch on here, maybe like the X factor or missing component to the success of anybody building protocols or projects in the DeFi crypto space, whatever. It's like, in the case of RWA Fi, I think there's really three major players, I guess. It's like Coinbase, Robinhood, maybe Solana, right? So you need some sort of like ecosystem backing from them, maybe. And so maybe what is your take on, like, for one, like, what is the fundamental requirements of having these teams, these foundations, whatever, actually like paying attention and like helping kind of like bolster the positioning of these protocols? And two, like, what is your experience actually tapping into that? Because I think this is a Base native ecosystem project, right?
Yeah.
So I've heard through the grapevine, Base doesn't have a great reputation as far as like
Supporting developers.
yes, the support alignment with people like yourself, right? So what is your interpretation on that? If that is a problem in the future, are you considering maybe migrating to some other ecosystem? Like, speak around that.
So a lot of that during that question, you guys were breaking up, and the
Oh,
little bar down there was red
Oh
was
no.
red, but what
okay.
I did catch was the end of that is are you thinking about other blockchains? I think was that the question?
No, it was more of like a, like an understanding that, like, to what degree of importance of getting support from, you know, Coinbase or Robinhood or Solana or whatever, in the context of, you know, you building out your protocol moving forward. And then
no, I think we could have launched on any blockchain and we're gonna win. Like I don't need like the base team for LienFi to win. I don't need Solana for LienFi to win. I don't need Robinhood for LienFi to win. And we're not like relying on that at all. You know, getting support is great. And I will say, like, Jesse at the base team has been fantastic. MYK, which stands for Mike, there's so many people there that I love, and they've been very helpful to what we're doing. But you'll never see me like post, oh my gosh, like I can't believe they have not posted about LienFi. Like that's just not going to happen. I will get on them about not posting about Grok has money because it's the biggest layup that like blockchains have ever been introduced.
Yeah.
But I would never do that with like my own product. It feels very cringe. But on the Grok has money side, I'm like, that's not my product. I didn't build that. That's something that naturally happened. This is the layup of all layups. You've been gifted something so special. Like just make sure it, you know, doesn't just make it work. But on the LienFi side, I think we can be successful like we don't need, I don't want to sound like pompous, but we don't need like base to pump our protocol. We don't need like, I think we're going to do really good things. And if you look even like some of the best protocols on base, they weren't like the most pumped by, you know, look at Clanker. I mean, Clanker was a number 2, at one point number 1, but you know, still to this day, I think top 5 revenue generating protocol on base. And in the earliest days, like before they even like captured product market fit, they weren't getting like pumped by it. I think that's like a lot of people like complain so much, oh, like where's our support? You'll never get that on LienFi, but you will get that on Grok has money because that's just, I feel like you got to do better on that one.
Yeah, I mean, we were sold as soon as we heard about it. If there's ever a meme coin that has, you know, because there's been so many meme coins that have sent just off of like Elon interactions. If there ever was one that has like a built-in like Elon button, it's definitely the one that's funneling value to his AI.
Yeah,
and like, you know, once he becomes aware of that, which probably doesn't require too much other than, you know, some sended energy.
I think it's like the coolest meme coin story. I still post about it 16 months later. I think it's great. I love it. I think it's great. So yeah, like stuff I like, I just post about.
Okay, cool. Well, we're definitely going to keep our eyes on this for sure. Like, you know, because this sounds important. We love new shit. We love, and yeah, we're looking forward to the pendulum. Being on the right side this time.
Yeah, we like these composable assets that we can play around with.
That too. Yeah, we might actually find like a use case ourselves to like, you know, integrate some of this into our own, you know, existing and future products, our own cooks. Yeah, because you know, we're paying attention just like everybody else, and like the signal's pretty loud that, you know, this is like crypto's new direction. I think it's pretty fundamental and like, you know, necessary. We all, if you're building in this space, we all have a collective understanding of like why it's important to like introduce these new Lego blocks and build on top of them, because out of all the other options, it seemed like the most likely candidate to actually like, you know, transition the world's perception of crypto again to a positive one, right? And that's ultimately what every cycle should represent, is like the attempt at that, right? It's like NFTs did a pretty good job of that in the 2020 cycle. It got everybody interested in like, you know, digital collectibles and digital value of things, and it poured over billions of dollars and millions of users, right? The following cycle, it
was a lot less of that.
I mean, there's a lot of money, but I don't think people had a pleasurable experience, right? And that's the difference. So we kind of got to redeem ourselves this time. And, you know, I think creating these new mechanisms and these new design approaches to, you know, just giving regular people access to these new financial instruments in a way that's like palatable, that's the most fundamentally important thing, right? Because clearly, like the existing infra rails for finance is not a palatable thing for most people, right?
Yeah.
Most people's access to exposure to that stuff is through their 401ks or whatever. Like it's like shit they don't want to deal with. But if you can make it like if you can make it like some sort of experience or whatever, a touch point that people actually want to deal with on a regular basis, then, you know, people are actually tapped into the direction of the economy for once instead of getting left behind. I think that's like
Yeah.
the big thesis for this cycle. And like all of us need to like work together to kind of like promote that and like, you know, in order to up our clout a bit as like, you know, because we're getting crushed by AI,
Yeah.
but now they're starting to look bad.
Yeah.
So it's our turn to start to look good, right?
Okay, Michael, appreciate for joining us. It's at Emily Jr. on X and at LienFi on X as well. Thank you so much for joining us. And we definitely would like to get you back on to talk about that white paper that you were mentioning, just to see how it all connects to the token.
Let's do that. Yeah, we'll stay in touch on it. And thank you guys for having me. Like I mentioned at the front, I've listened to you guys for a long time and enjoy listening to you guys and catch different sound bites and episodes. And it's an honor to be here. So thanks for having me.
Yeah, absolutely. For everyone else, all the links will be in the description. We will catch you in the next podcast.
Peace.